All right, what's going on, everybody? Welcome back to the MIE Trading Podcast, the podcast where I share my knowledge and experience on day trading strategy, risk management, and psychology so that you can become a better trader. My name is Brendan Murphy, and today I'm going to be sharing with you my 3-step routine that I do every day to make sure that I'm avoiding as many bad trades as I possibly can. It's super easy and it's going to have a significant impact on the quality of your trades. So before we get into that, please remember to hit the subscribe button if you're new here so that you never miss out on the latest way to improve your trades. So being on the right side of the market is paramount to your success as a day trader. This is pretty much a given, and it doesn't matter if you've got a strategy, and let's say you're using TradingView, you've got a strategy, you've got that in TradingView and you've back tested it and it looks super good. That's cool, but that doesn't matter if that's generating short signals in a bullish market, and it also doesn't matter if you're generating long signals in a bearish market. It doesn't matter how good the back test is over time. If you're getting those bad signals in whatever market you're in, then those back test results can be improved. And as I said, it's an easy 3-step routine that's going to take you less than 30 minutes a day. So what I'm going to show you how to do is how to avoid taking those bad trades so that you can increase your win percentage, increase your risk reward ratio, your expectancy, your profit factor, pretty much all of the statistics that you need to make sure you're a highly profitable trader. And if you do use TradingView's strategy tester feature, if you use TradingView to generate signals to trade, this is even more important for you because this is how I trade myself. And this is, I'm sure you've had moments where your strategy has generated a trade and, for example, it says long, and you look at it and you're like, that's a bad trade. And you either don't take it because you believe it's a bad trade, or you do take it because you realize how important it is to follow your strategy no matter what. This is personally what I do. And there is plenty of times where I look at my strategy and it says go long, and I think, man, that's a bad long. I don't want to take that. I take it anyway because I realize how important it is to follow my strategy. However, what we can do is take in a fundamental view of the market and make that part of our strategy so that we can say no to those trades that we know are bad without violating our strategy, without violating our rules, and without ruining the ability of the law of averages to play out in our favor long term. And at the end of the video, I'm going to be giving you free access to my fundamental variable checklist, as well as a correlation coefficient script that you can use to check the correlations between any fundamental variable and any stock that you want to trade, pretty much just like that. So that's a cool little added bonus. So now let's get into the meat and potatoes of the video, and we'll begin with step 1. Step 1 is create your market fundamentals checklist. This is a list of market fundamental data that you're going to go through every day and update the price on. The price, the level, whatever the value is. You don't need to spend hours looking at different companies. You don't need to go, okay, how's Tesla performing? How's Apple performing? How's Microsoft performing? What are their PE ratios? You don't need to get analysts' forecasts on the companies. It's too much time, and the return on our time investment there is just not worth it. And if we're trading with TradingView's strategy tester feature, we really like technical analysis. I specialize in technical analysis. So what we're trying to do is work with our technical analysis strength without spending all day looking at fundamentals. So as I said, just make a list of fundamental variables that you need to track every single day and track them every single day. For example, some things you might want to include might be the inflation rate. You can include the interest rate, unemployment numbers, the consumer confidence index, or gross domestic produce. All of these things are pretty highly influential fundamental factors which will likely overturn any technical analysis signals that you get. For example, if you get a perfect technical analysis long signal and 9 times out of 10 it works, but it's the 1 time out of 10 where you get a fundamental variable change such as inflation skyrocketing, that's going to send your long signal downwards. It's going to be wrong, and you could have avoided that had you tracked these fundamental variables. They're examples of some of the variables you might want to track. There are a ton of others, and again, they're all included in the checklist that I'm sharing at the end of the video. And you want to track these every single day so you can get a clear view of how they're trending over time, as well as be aware of when they start to change so you can see, or so you can maybe get in ahead of the rest of the market and give yourself an extra edge. So that's step 1. Step 2 is you want to create a table of correlation coefficients between all of these fundamental variables and the stock or stocks that you like to trade. Now that sounds kind of complicated, but it's really not. The correlation coefficient is a number between -1 and 1, and all it means is how closely related are these two things. One example of a strong correlation coefficient might be, let's say, if you look at the correlation between the S&P 500 and the Dow Jones Industrial Average. Those, they like to move up with each other, they like to move down with each other. They're not perfect, but they're very, very close. So the correlation coefficient between these two would be very high. At a guess, maybe it might be 0.9, 0.95, something like that. And a strong example of a negative correlation coefficient might be inflation and the S&P 500. That's probably going to be a negative correlation. As inflation skyrockets, the consumer confidence goes down, the Fed starts to tighten monetary policy, they start to raise interest rates, they cut off the money supply from the people can't buy as many things, so stock prices go down. So that's an example of a negative correlation. It might not be as strong as the positive correlation I explained before, but nonetheless, there's probably a negative correlation there. And basically, you can find out the correlation coefficients of all of these variables. In fact, you can find it out for anything you want that has a chart, basically, and you can easily just plug in the formula and it will spit out the variable for you, or spit out the number for you. So let's give 3 examples that we're going to use for the rest of the video to show you how useful this is. So for example, you might find correlation number 1 is when inflation increases, your stock that you like to trade decreases. This is a negative correlation. And let's just say that it's -0.6. You might also find that your stock increases when GDP increases. This would be a positive correlation. For the example's sake, let's say it's 0.3. And then thirdly, let's say that the unemployment rate has a negative correlation with your stock price. Let's say this one's weaker and it's -0.1. It's a lot of numbers, but don't worry, they are not what are extremely important here. So in this example, the negative correlation with inflation rate is stronger than the positive correlation with GDP, and the negative correlation with unemployment is weaker than both of those examples. And basically, we can use the strength of correlations, either positive or negative, to weight as in W-E-I-G-H-T, to weight how influential these variables are on our trading. And don't worry if that sounds kind of confusing, it's all going to make sense in a sec when I explain step 3, which is use these correlation coefficients every day, along with tracking the changes in all the fundamental variables to determine which side of the market you're going to trade on that day. So before you trade, you do your 15 to 30 minutes updating the fundamental variable levels, and then based on those and the weights, you're going to say, all right, today I'm taking longs, or all right, today I'm taking shorts. So let's continue with that previous example. Let's say that GDP is up, inflation is up, and unemployment is also up. And again, that's to keep it simple. Let's say that they're all up 1%. So if inflation is up, that suggests that in this example, your stock's going to go down. And this is the highest weighted variable here. The second highest is GDP is up, which suggests the stock is going to go up. This is the second heaviest weight. And the third in the example is unemployment is up. This suggests the stock will go down, and this is the lowest weight. So let's just weight those 3, 2, and 1. So we have 2 variables that say stocks will go down, and when you combine the weight of those, that gives you weight of 4 saying that stocks will go down, and then you have 1 variable saying stocks will go up with a weight of 2. So what this would indicate is that on this day, because you have this correlation coefficient data, you can say that when you factor in the weights, stocks are twice as likely to drop on this day than they are to rise. That doesn't mean they're guaranteed to drop. There is still a chance that they rise, but you can say that they're twice as likely to drop than they are to rise. So what you would do with this is say, all right, today I'm going short and I'm not going to be taking longs. Or if you want to be a little more conservative, you can say, all right, today I'm going to halve my position size on long trades just to reduce my risk a little bit, while still allowing me to take advantage of those long positions if the market does decide to go up. Again, it's up to you which one of those approaches you take, but either way, you're going to be benefiting from this fundamental variable analysis. And then once you've done this whole process, now it's no longer seeing your strategy tell you to go long and then you go, I don't want to take it. now it becomes part of your strategy. So you never have to hesitate. You never have to feel bad. You're not going to feel guilty. You're not going to feel remorse. You're going to be more rational and calm. And we all know how important staying rational and staying calm is for a trader. So basically now you're just expanding your strategy. You're taking in more data, getting a broader view of the market, and you're getting a bigger picture view to align your trades accordingly. So that concludes the 3-step checklist that you can use to ensure you're on the right side of the market more often than you are not. Remember, in the link below, you can find a link to my website, and there you'll be able to get my entire fundamental checklist that I use myself, as well as a TradingView script you can use to check the correlation coefficients between each variable and the stock of your choosing. Please remember to subscribe to the channel if you thought this tip was cool, or if you want to see more tips like this to make sure that you become a better trader. If you liked the video and you found value out of it, maybe hit the like button, share it with a friend if you think they're going to find it valuable as well. And as always, you can find all of my professional services at MIE.trade. So thank you very, very much for watching the video. Hope you found it valuable, and I'll see you again later on in the week. Bye-bye.